Let's talk a bit about Lyft. You know how these shows work. How unusual is the action this early into public life?
Well, I don't think this is unusual at all. From Lyft's perspective, they desperately needed to raise as much capital as they possibly could get. So they're going to price the thing to whatever the limit was that they could get the offering done. And you saw even the day of the original public offering that it hit its peak early on and then sold off all day. I think from the point of view of Lyft management, this is just, this is just something that happens. And I think if you're a public shareholder, you want to, tighten up the seatbelt because it's not at all clear that, what the business model looks like long term. So stocks can be amazingly volatile. But let's face it, it was an immensely successful IPO. And from the company's point of view, this was mission accomplished.
So no cautionary tales for IPOs to come?
Oh, hang on, my friend. You and I have talked about this many times in the past. I think the IPO market is always really dicey. And, the thing to remember is that the goal of the management team in this case is really different than the goal of the public investor. And from the public investor's point of view, this is a company that's a long way from profitability, where it competes with a much larger player, Uber, which is also a long way from profitability. So in my mind, I worry about this thing. The last time I was on, we were talking about this as sort of a Sirius versus XM kind of situation, where you have two viable players now because Lyft is public. They have two viable players. They have potentially a death match until they finally find a way to merge. And for the public investor, I think that's going to be super tough for, a long time.
Hey, Roger, it's John. So explain to me, though, how you get this 20 times oversubscribed situation. They raise the range to 70 to 72, leading into the IPO itself. And then it falls, where is it now, 68? 69, it suggests that the people who have been invested in this stock up until the IPO don't believe the pitch that the company was giving to the public investors just a few days ago. I mean, am I reading that wrong?
Well, I mean, it's pretty obvious that the people who were looking at the IPO had a very short time horizon. And, to my mind, the people who owned the stock in the private market, their situation was really simple, which is, get liquidity. And, all the valuations in the private market were lower. So from their perspective, any price was a good one. But the higher, the better, because this is not a company whose future was completely made before the IPO. They need a lot of capital to make this thing work because Uber can outspend them. And, from my perspective, I don't want to read too much into it. I mean, there's more sellers than buyers right now. And why that shouldn't continue, I don't know, because, again, the company is such a long way from profitability. And what are these businesses really worth long term? I don't think that's obvious. But I do think, and we've talked about this, John, many times, that the way the private market has valued them, in my mind, is not the way I would do it.
Roger, I want to go back to this idea of comparing Uber and Lyft to Sirius and XM and the fact that maybe the path to profitability is going to be a merger between these two names. Is that something that could actually even come to fruition in terms of antitrust and what regulators would be looking for in terms of competition in the marketplace?
Hey, Morgan, that is such a good question, particularly at this moment in time. As you know, I'm actively engaged in looking at antitrust issues in a different context. And the one thing I can tell you is after essentially 16 years, 2 administrations, where antitrust was moribund, there is a real interest now in looking at concentration of economic power, and not just in tech. I mean, the whole economy is overly concentrated today, and that makes me very nervous. I would also suggest that in this particular category, it's not anything like the kind of threat it is in internet platforms or some other areas, but there's no way to know what regulators are going to look at. I can't imagine this is the highest priority, but who knows?
Finally, Roger, we don't often talk about Seaport Global, but they do have a sell rating on it today, price target 42, as they argue in the future people are going to own cars and they're going to ride share as a supplement. Does that make sense to you?
Yeah, I got to be honest with you, Carl. I look at the trends of people getting driver's licenses later and later in life. And, it feels to me like there is a massive transition coming in how transportation works in the United States and probably around the world. But the country hasn't made the investment in the infrastructure for driverless cars that I would like to see. And so I don't know what the slope of that looks like. But with younger people, Uber and Lyft is how they're getting around. And to me, the issue isn't the demand side. It's the pricing. and it's the terms under which they do business with the drivers, which I think are manifestly unfair. So I think all of those things are going to have to get fixed.
We'll pay close attention to it, of course, with your help. Moving on to Facebook, Roger, you published your own op-ed this morning in The Guardian in response to Zuckerberg's over the weekend, calling his proposal on new rules for the internet, quote, a monument to insincerity. There has been some rolling of the eyes collectively since his Washington Post piece. But what do you mean exactly?
Well, what I mean here is, first of all, let me give Mark a lot of praise for at least engaging in the conversation. I mean, Google right now is still pretending as though this stuff has nothing to do with them, and I don't get that at all. Mark is basically playing catch-up, that the politics of this thing have changed. And if you're Facebook or Google, right now, you're in a situation where there's a growing consensus that the business model is causing more harm than we can tolerate in civil society. And so there's going to be regulation. Mark's trying to frame that conversation in the way that is most favorable to him. Good for him for doing that. But I just want every policymaker and every citizen to know that what Mark has done in his 4 proposals is basically try to avoid responsibility for hate speech, trying to avoid responsibility for election manipulation that's going on in the platform. And he's trying to misdirect us relative to privacy and to data sharing by having us only focus on the data that people put into his platform, which is at most 1%. The real problem here is metadata, which is the data about what you're doing when you're on the platform. It's the data that they collect from your internet browsing history, and it's the data that they acquire from third parties that might be your most intimate financial data, health data, your location data, and other browsing history kinds of things that they wouldn't get internally. And that's where the problem is. That's where the regulation has to focus. And it's way more than just Facebook. It's Google, and it's increasingly Amazon and Microsoft.
I'm glad you brought up Google, Roger, because you mentioned in this op-ed that, you compare Facebook versus Google, which you say is guilty of many of the same business practices and harms, yet has received far less attention for them. A, why do you think it has received far less attention? And B, does that speak to the fact that you have a company and a CEO there that's implemented a very different strategy, was down in D.C., for example, last week, meeting with the president and others?
So, Morgan, I really think what's going on here is Facebook had Cambridge Analytica, and that got everybody to pay attention, and Google did not. I think the reality here is that the problem from a business model perspective actually began with Google. There's an amazing book by a woman named Shoshana Zuboff, who's a professor at Harvard Business School, that is called The Age of Surveillance Capitalism. And Zuboff makes the point that Google had an insight in 2002 that it could basically gather data everywhere. It could lay claim to data that was in public spaces with things like Street View and Satellite View and Google Glass and Pokemon Go. It could grab all of our data online by either acquiring it or tracking us everywhere we go and create a market for behavioral prediction. And the key thing about this is that Google has executed this not just brilliantly, but also surreptitiously. It's done a lot of things to keep us from seeing what's really going on, particularly with things like Gmail, where, it put ads in there at the beginning to justify scanning the emails, knowing, I think, that we would push back on the ads.
It seems to me like the lesson from this Zuckerberg proposal, 4 parts, is that he's filling a void. I mean, here Facebook is. It has a co-founder and CEO in Mark Zuckerberg who can speak clearly. And unless you're Europe, which has a very clear regulatory agenda in this tech era, if you're the U.S. or the rest of the world, nobody can seem to decide what they want to do here. So Zuckerberg's trying to fill that void and saying, hey, I'll tell you what you can do. Here's how you regulate me.
I think that's exactly what he's trying to do. And my basic point here is that we shouldn't let him form the agenda and frame the conversation.
Well, who else is going to do it?
And we'll see how that turns out.